Hello, everyone, and thank you very much for being with us here today. I cannot believe that another year has gone by so fast. It really does not feel like it should be Christmas yet. During this webinar, we will be reviewing payments compliance in 2024 and looking at what's in store for next year, with key legislative initiatives across the world still taking shape. In payments, it's felt like we have had non-stop new rules and regulations in the last few years, such as PSD2 for consumer duty, DORA, ever-changing AML requirements in the UK, EU and beyond. And soon, in the EU at least, we're going to have the instant payments regulation and the PSD3 and PSR coming in, as well as the new open finance framework and possibly a digital euro, not to mention in the UK, we're going to have the implementation of the national payments vision, while some firms grapple with not just new authorized push payment rules, but potentially new safeguarding obligations as well. Anyway, need I say any more? Compliance teams have never been busier, and even in times of ChatGPT, many are going to be stretched. Before we get started, though, I wanted to give you all a bit of an introduction of what we do at Vixio. We are a RegTech company offering independent, authoritative, and actionable regulatory intelligence for compliance, regulatory strategy, and development professionals. We help you understand the impact and opportunities for businesses so you can stay on top of regulatory change to meet your obligations and identify growth opportunities. And as for me, I'm Jimmy, and I work as a senior journalist on Vixio's editorial team, predominantly covering the UK and EU. I'm coming to you today from a miserable, cold, wet, windy London, whereas my colleague Prasad, meanwhile, is coming to us from a considerably warmer Malaysia today, if I'm to believe BBC weather.
Indeed, I am Jimmy. I've decided to fly south this winter. Hello, everyone. I'm Prasad, and I'm one of the analysts here at Vixio, and I specialize in the APAC and Middle East and Africa regions. It's been a busy year in this bit of the world too, and I look forward to reviewing at least a bit of what's gone on with you here today.
Absolutely. I think there's plenty of common themes between, the UK, EU, US, and also further afield in APAC as well. So yeah, plenty to be discussed. So I think a good place to start would be open banking and open finance, because so much has been happening on open banking in particular in the UK. The UK used to be a leader on open banking, and certainly there has been a feeling recently that maybe a lack of decision making has made things a bit, let's say, maybe we're not as much, leading in the same way that we used to. But there is still an endorsement from the UK government who feel that this could be a method of building competition in the payment space. That was something that came out of a national payments vision, which was released last month. And now a question of whether government can reinstate momentum remains with us. We have the FCA taking control of open banking, which seems to be what people wanted, and actually should hopefully help move some of those decision-making issues to be something of the past, let's say. People who were frustrated about open banking's lack of progress in the UK are starting to feel a bit more positivity about things. But that's also in the EU. There is also work going on as well. The EU is shoring up open banking with its payment services regulation. And, certainly there is more work to do there to see success. And with the payment services regulation, or PSR, we've definitely seen some awkwardness when it's come to actually getting it across the finishing line in the European Council, at least. So I'm, thinking in 2025, what's going to be really interesting is seeing how quickly the European Council can come to a decision on some of those kind of more complicated issues that they've had so far with dealing with that legislation. And I suppose as well, we've got things like the national payments visions in Ireland and France, which are both signalling a keenness for open banking to, offer the same competitiveness that the UK thinks it does. And when it comes to open finance, the UK has also signalled that it wants to see some progress being made there. Certainly, we've got things happening with CFIT, which is the body that's overseeing some of the innovations of open finance. And, it'll be really interesting to see how much progress they actually make in being able to get things to begin happening and hopefully get regulators' attention. And then we've got FIDA in the background in the UK as well. And surprisingly, FIDA, or Financial Information Data Access framework, is hopefully going to be able to bring open finance into the mainstream for the EU, Obviously, there is the caveat that things could go the same way they've gone with open banking, where it's not necessarily had the success that people wanted it to. So with FIDA, what we've seen so far is that it's actually managed to get more momentum than the payment services regulation, which nobody really expected. And we've also seen quite a lot of movement in terms of the European Parliament, at least, wanting to see some players in the market, particularly the big tech players, limited in what they can do in FIDA. So open finance, even though there is more progress technically than the PSR with open banking, open finance still feels a long way off from a regulatory point of view in the EU and perhaps in the UK as well. I suppose from my perspective, I would say that I think open banking and open finance still needs to find its, viable, beneficial use cases. We've seen some happen already. HMRC, for example, in the UK, which is the tax collector, has got a really interesting open banking model that it uses. And I think, having spoken to my friends who are self-employed, they're very engaged with it. They don't necessarily say that it's open banking, but they're very keen on doing that as opposed to the other methods of paying your taxes. So really, I think that the UK and EU, although they were ones to set the standards, have a lot of work to do to come up to standard with other countries, where there has been a bit more success so far with open banking and open finance use cases. And Prasad, perhaps you can shed some light on that.
I'll try at least. I definitely agree that it's been a very busy year for open banking and finance across the globe. It's definitely been a combination of trials and calibrations, the former much more so in newer markets that haven't done open banking before. And there are a lot of those that are keen to get into the open banking sphere, and a lot of calibrations in mature markets where open banking has either been very popular or is not as popular as regulators would hope. We've seen India, for example, bringing more and more payment aggregators into the regulatory ambit of the Reserve Bank of India, with the Reserve Bank sort of realizing this year that it needs to put up some guardrails for payment aggregators, which form such a big part of payment processing for both domestic and overseas transactions in that part of the world. Moving further east to Australia, on the other hand, which has released brand new consumer data right rules. Now, Australia spent a lot of money on its first version of consumer data right, but got little to no response from consumers. And they hope that this new version, which allows for bundled permissions and pre-selected consent, will help catalyze take-up of consumer data right among Australians. I believe they're starting with trials with energy providers. So it'll be interesting to see whether that acts as a weather vane for other industries and other use cases for open banking moving forward. I think you're also right in pointing out that the use cases for open banking has changed over time, even if they're not the most obvious. The Philippines, for example, which has just conducted its first trials on open banking, sees it as a way of thinning the herd of payment service providers in the country. Now, the Philippines has gone e-wallet mad in recent years, with dozens of operators popping up in a market that has gotten so saturated that the Banco Central had to impose a moratorium on new licenses, and they are hoping that a suitable open finance regime that allows customers to easily switch between providers will thin the herd in a market that's already had far too many competitors as far as they are concerned. But
just wondering, with Philippines, has it been a success so far, open banking and open finance? Because it seems like it's quite a crowded market. Like it's kind of reminding me of, maybe for our European viewers, Lithuania at the moment.
I think it very much is. It's a bit too early to say at the moment as they've just finished their preliminary trials, but the sense that we are getting from the Banco Central and other regulators there is that it's something that they are willing to push hard and something that they want to push a lot as we move into 2025. Now, I wonder, Jimmy, actually, whether open banking is a thing in the US as well. We've seen an explosion in regulated firms opening up there, and Canada as well with the new registration rules.
Yeah, absolutely. I mean, one of the big complaints that there's been with the US and Canada is a lack of progress on payments and open banking with that. certainly for a long time, people were getting very irritated with how far behind the EU and UK the US was becoming on payments innovation and on open banking. The Consumer Financial Protection Bureau, which is one of the probably most interventionist regulators in the US, and there are rumors that maybe will not be there much longer if we are to believe some things that President-elect Trump has said. They did bring out a proposal earlier this year on regulating how financial institutions provide consumers with access to their financial data. And this has now progressed to final rules that will mandate institutions to make consumer data more accessible. I think there's definitely been a bit of a rush in terms of getting out a lot of different consumer protection focused and competition focused things in the last few months. I guess because they knew that there was going to be this change in administration in one way or another that may shake things up. So under the CFPB's new rules, which is on part of the Dodd-Frank Act, which actually came in, decades ago, financial institutions will have to secure or provide secure consumer permissioned access to account data through APIs, promoting transparency and competition. They're going to need to establish obligations for third-party data aggregators to protect consumer data while enabling portability. It also aims to boost innovation in fintech while ensuring consumers maintain control over their personal financial information. So I think it's going to significantly affect banks, fintech companies, and third-party service providers, because there are going to be new compliance obligations for all of those stakeholders, even the fintechs who have been used to operating in a pretty unregulated field, maybe with, similar to the UK and EU, where you have the banks who were the, I guess, gatekeepers of this data in a way that they're not necessarily going to be anymore. They are going to have to offer out some data for free. But they are, so it's really going to reshape data sharing in the US. There has already been a lawsuit filed. So it does look like it's something that banks are quite frustrated by. I think fintech companies are pretty positive about it. And certainly there's been a lot of talk at conferences recently about fintech companies being able to possibly move into the US in a way that they didn't necessarily want to before. They finally have this regulatory clarity, a bit like the UK is starting to offer with the national payments vision that makes them think, actually, we can start to put our money here. Yeah, there's going to be compliance obligations, but at the same time, we know what's coming up. Now, there is one crux to all of that. Obviously, there is a new administration coming in, and that new administration doesn't necessarily like the CFPB, certainly doesn't like the chair, Rohit Chopra, and there is every chance that things could change again. I do think that there is a bit of a bipartisan acceptance in the US at the moment, that banks, there is a bit of a monopoly there. And Patrick McHenry, who is the chair of the Financial Services Committee in Congress, did give his endorsement, let's say, to the new rule. So I think there's a sign, and he's a Republican. So there is signs out there that this rule will remain in one form or another, whatever happens after the new administration comes in. I don't necessarily think that open banking will be a priority area for them, but that might end up being a good thing, because it might mean there won't be any drastic rewrite straight away.
Interesting. So it's a question of both whether it's going to be watered down or whether it's going to exist at all.
Yeah, I would say at the moment, and this is just my take, no one take this as literal, but I think there could be a chance of it being watered down slightly. But I think there's also, as I said, like certainly an acceptance that there's a bit of a banking monopoly at the moment in the US that people want to take on. And you've got to look at other legislators, because obviously in other jurisdictions that are pretty comparable with the US, there has been so much more progress made. And I think if you look at regulators in the US and speeches they've made recently, a lot of that is focusing on needing to update the payment system. That's happened with FedNow, and other stuff focusing on how the payment system has changed so much, even in the last 5 years. We've really seen big tech companies move into it. So there is an acceptance that things do need to, in some way or another, change when it comes to policy, for sure. So yeah, and also with the customer protection side of things, I think that's been something that's been going on around the world. So even beyond the US, this has really been the year of the consumer, with regulators doing their best to ensure that they're not only getting easy access to payment products via open banking, but also striving to do things that are videos that they better protect their customers when using these products. Prasad, I wondered whether you could talk for a bit on what's happening in Asia this year with customer protection, because Singapore is one of the countries that I follow quite closely on the editorial side. I know that you do as well when it comes to some of the announcements they've made.
Well, you're definitely right, Jimmy, that it has been a big year for consumer protection legislation, not just in the Eurozone, but all around the world. And Singapore is one of the leaders when it comes to this. And now, fraud has been on the rise in Singapore, especially with more and more people moving towards cashless payments. And the Monetary Authority of Singapore has definitely taken notice. This year, there are two significant pieces of legislation that they've introduced. The first is the shared responsibility framework, which went into effect earlier this year. And what it does is it essentially shares out liability for fraud or for scams among the telcos that helped enable the scammers, the financial institutions themselves, and the person who has been scammed, depending on how much liability each one had for each particular case. Now, Singapore has also introduced scam protection orders, which currently only apply to banks, but which I expect will eventually be expanded to payment service providers. But basically, these orders allow the police to put a block on an account of someone who they believe is being scammed, but who is willfully failing to recognize that this is happening. Now, I think it's important to also note that consumer protection and customer protection really goes beyond fraud. I think regulators are starting to realize that they don't just need to protect consumers from scammers, but occasionally from payment service providers themselves, especially in their view. Malaysia and Singapore, for example, have both introduced fair dealing guidelines this year in efforts to make sure that customers are treated, basically get fair treatment from their payment service providers. And this is very important when you have lots of people who have never used online banking service or e-wallet before. They might not necessarily have all the tools they need to deal with when speaking to their provider. So it's important that they are treated fairly, and regulators are starting to take notice of it.
With the fair dealing guidelines, I think it's pretty similar to the consumer duty in the UK. Like, how can payments firms actually comply with these guidelines?
I think they are not as extensive as the consumer duty regulations are in the UK, but compliance is just a matter of benchmarking. There are principles that are put in place. There are examples of this, and they are very clear principles and examples. So it'd be I'd say quite difficult not to comply rather than more difficult to comply.
Interesting. Nice.
I'd also like to say that, regulators continuing on this trend of looking at customer protection beyond the lens of fraud. Because in Australia and New Zealand, they're even starting to think about whether consumers are paying a bit too much for their payments. And Australia and New Zealand are both currently consulting on whether or not they should intervene to control the amount of interchange fees that consumers are charged for using their cards on a day-to-day basis. Again, this is hardly surprising. As more and more people use cards, they are becoming more of an essential payment method, especially in Australia and New Zealand. And with interchange fees as high as 12% of overseas card transactions, it is no wonder that both the Reserve Bank of New Zealand and the Reserve Bank of Australia are taking notice.
Yeah, absolutely. I think that interchange is also something that's been coming up in the UK. Certainly post-Brexit, there's been some rules being made to try and ensure that the EU and UK cross-border interchange remains what it was before Brexit, because it did increase after Brexit. That was one of the things that politicians got quite upset about on the Treasury Select Committee. So the Payment Systems Regulator, or PSR, has stepped in on that. I have to say, in the UK, the app fraud, I know that you were saying about consumer protection not just being fraud, but it has been the thing that's pretty rich. Been like this most significant theme, let's say, of this year when it's come to the work that the Payment Systems Regulator is doing here. The app fraud reimbursement rules have come in. There was so much fuss beforehand. It was actually making national headlines. And I think it was pretty much the first time I'd ever seen the Payment Systems Regulator making national headlines. certainly every single bank seemed to be suddenly emailing out and giving all this advice on app fraud, because I think they knew that there was going to be this tidal wave of changes just about to come around the corner. Now those reimbursement rules are in, and 85,000 is the cap. It's down from the original cap that was supposed to be in place. Not many payments firms are that happy about the cap as it is. And I think even though it's gone down slightly to 85,000, it's still going to be something that's going to be quite frustrating for them. Now we are in the waiting period with it though, and whether these rules are a success story or whether we see other jurisdictions following suit, or if we're going to simply go back, going to see app fraud continuing as it is, just the banks a bit more out of pocket, is going to be a huge focus for next year. I think that the role of social media and telecoms firms and some division over what should happen next is something that we are going to see. The PSR is due to bring out, and they may have even brought it out while we're doing this webinar, because it is supposed to be quite soon. But the PSR is supposed to be bringing out rules on platforms and, well, not rules, but basically looking at where the source of fraud is, which could see some of the big tech firms that have really encountered a lot of scrutiny, also from politicians as well in the UK now. We've seen the new government concerned about it. We saw the Home Affairs Select Committee in the last government also making some noise about this. But I think we're going to see social media and telecoms firms coming under a lot more scrutiny for their role in fraud and their role in preventing fraud. And I think we could start to see a liability model similar to what's coming in Singapore, coming in the UK. This has certainly been the case in the EU as well. The European Parliament has made amendments to the Payment Services Regulation, suggesting that social media and telecoms firms do need to be held liable. Whether that comes through or not in the final piece of regulation, though, is, I hate to use this term, but it remains to be seen. It's certainly something that the European Commission and the European Council are not enthusiastic about at all. And the European Commission, actually, I was at a conference and they were pretty much saying that it's going to go against rules that they've already brought in on big tech firms, such as the Digital Services Act and the Digital Markets Act, which were definitely centerpiece pieces of regulation that were coming out in the last mandate. So I think it's going to be interesting to see how far these jurisdictions move on this, particularly with a Trump presidency, where there's already rumors that Trump's going to set up some kind of trade war with, the EU or UK about stuff. If there was to be attacks on some of their most successful companies in the US, I don't think that's going to go down that well. That's not to say, though, that the banks in the UK and EU are not causing consistent protest about this. All I've seen the last few years coming out of the banks is so much data on where fraud is coming from onto their networks. So that, we've seen data coming from Revolut, we've seen data coming from NatWest, from Nationwide. So it's not just the big banks. It's not, we've seen the fintechs and also some of the more established banks making, saying that this is a problem in the UK that does need to be solved. And it's certainly something that trade associations in the EU have been warning the Commission about as well. I wanted to ask as well about Australia, Prasad. Have you seen much happening with scam work in Australia? Because I thought, well, one of the things I remember seeing earlier this year was there was a bit of a framework being put in place to tackle scams.
I think that there has been a rise in scams in general. I can't say what the exact framework is at the moment, but I think Australia in general is starting to reform the regulation of its payments industry. We've seen that with the consumer data right. We've seen that with new digital identity laws, which are going to strengthen the use of verification via digital ID. And just in terms of regulating payment services firms, we've had the new buy now pay later rules, which have just passed in Australian Parliament, which will regulate buy now pay later companies as credit providers in Australia. Now we've seen a huge explosion in buy now pay later in Australia. Now what was once only used for relatively large purchases can now be used for everything from your weekly food shop to even a meal. So it's no wonder that regulators are starting to step in on that. And while we're talking about scams, I don't think it's any surprise that in the EU there is some appetite for including social media and telcos in it, for including social media and telco companies in liability for scams. I mean, as you said, the big banks can only do so much, but if you can't plug the source of the scams, it seems a bit unfair that they are being made to bear the brunt of it.
Yeah, absolutely. It is one of the big themes that has been coming up this year, and I don't expect to go away anytime soon. So I think it's going to be something we're going to see happen in 2025. And there has been a bit of a signal at the moment from the Chancellor, Rachel Reeves, that she wants to see more work being done by social media and telecoms firms on tackling fraud. That was one piece that came out with the National Payments Vision. Another thing I was going to raise for the UK, just before I forget, was that there is the safeguarding account rules that are coming in. As we know, funds held by payments and e-money firms are not directly protected by the Financial Services Compensation Scheme. Instead, firms will have to safeguard their funds, which can mean customers lose money or experience delays to funds being returned if the firm fails. And the FCA has been pretty hot on this. They wrote to payments and e-money CEOs in March 2023 about their safeguarding and wind down arrangements, and have since opened supervisory cases relating to, I think, 15% of firms to that safeguard to address its concerns, which is a pretty big chunk or sizable majority, a minority, let's say, of payments and e-money firms in the UK. So under the FCA's proposals, the existing e-money safeguarding regime will be replaced by a client assets or CAS style regime, which is designed to work with payments firms' business models. And next year, we are also expecting the FCA to publish interim safeguarding rules that will be that firms will have to comply with until legislation goes through that will really shore up safeguarding obligations on firms. Similar stuff happening in the EU as well, maybe not as prescriptive as the UK has been, but I think it's certainly a hot topic at the moment for payments firms. And, certainly the debate there's been so many stories in the UK of court cases where funds haven't necessarily been returned to companies. So seeing that get changed, I think, is definitely a priority of the FCA at the moment. And there's similar stuff happening in the US with that as well. So the federal or the FDIC has put a proposal on safeguarding custodial deposit accounts. And this is same in relation to risks identified in non-bank payment service providers' operations. And the rules are looking to enhance the safety of custodial accounts, which will mean that payment firms are going to have to provide much clearer disclosures about FDIC coverage for client funds held in custodial accounts. And firms are going to need to improve their tracking and notification systems to ensure compliance with these new deposit insurance coverage limits. So this is going to mean more reporting and auditing requirements for client funds, and certainly hopefully is going to mitigate some of the risks related to insolvency and misuse of client funds that have been a problem in the US. I feel like we do need to move on to one of the other topics that's certainly been quite a big deal this year. And I don't know if it's been the case in South Asia and elsewhere as well, but operational resilience. Have you seen much of operational resilience happening in some of the jurisdictions that you're looking at, Prasad?
I think there's definitely been a lot on it. I think a lot of firms, a lot of regulators have started to wake up to the fact that it is such a vital part of regulation. And it's no surprise we've seen in recent months titans in other industries, losing access to all their systems or having systems go down because of either shoddy equipment or bad cybersecurity policies in place. So there's no surprise that regulators all over the world, in one of the most highly regulated industries in the world, are doing their best to ensure that the same doesn't happen, especially when you've got a service so essential like payments. Now, in the APEC sphere, we have the usual leaders in terms of regulators, and they've all got their big flagship pieces of legislation. Singapore's new regulations under its Financial Services and Markets Act, India's Master Direction on Cyber Resilience went into effect later this year, and Malaysia is currently consulting on its risk management exposure draft. So lots of movement there. But even regulators further afield are starting to realize that they can't wait. They can't adopt a wait and see approach to see whether they need similar pieces of legislation. South Africa, for example, issued a directive on cybersecurity and cyber resilience within its national payment system earlier this year. And Israel, whose new licensing regime for payment service providers went into effect in June, issued with the new licensing regime comprehensive instructions on cybersecurity standards. So I'm emphasizing how important that cybersecurity and cyber resilience is for even a brand new licensing regime.
And not to put you on the spot, but do you notice at least regionally there being similarities between the regulations that are coming out? You know, for example, between Singapore and Malaysia? Because I was like, I'm thinking if you are a payments firm or a bank that's located in these different jurisdictions, are you having to, you know, fill out various different compliance reporting forms, or is there a way of streamlining that work?
Sure. I think there's always going to be some similarities, not just regionally, but globally. At the end of the day, so your cybersecurity concerns don't change just because you're in a different country. You need to have adequate testing, you need to have adequate systems in place, you need to have adequate personnel in place, for example. So I think there's going to be a lot of overlap, and rightly so. And I'd be concerned if there was a piece of cybersecurity legislation or cyber resilience legislation that is quite different from what we would accept as mainstream concerns.
Yeah, absolutely. And in the UK and EU, we are also on the cusp of operational resilience rules being introduced in Q1. And in recent months, we've seen regulators making plenty of noise about firms needing to prepare for compliance. I would say that the Digital Operational Resilience Act, for example, in the EU, is probably one of the big priorities across all 28 or 28 EA members when it comes to what they need to be doing to prepare for the DORA, basically standards that are coming in as of January. And one of the things I've really noticed for national regulators starting to do whenever I go on horizon scanning is bring out surveys of preparedness. And that's included identifying vulnerabilities and aligning internal processes, which a lot, you know, payments firms, e-money firms, and also crypto asset service providers are going to have to start thinking a lot about as soon as that deadline hits. Whether we start to see enforcement action happening yet, I'm not so sure. I think it could be a while, but this is a priority. And I would say there's a lot more awareness coming out of different jurisdictions on compliance with DORA than there was with, for example, the PSD2, where we haven't necessarily seen as much direct action being taken against firms and not many fines being put out there. I think that there will be one unfortunate firm making history, maybe towards the end of next year in Q4, as the first firm to be fined for failing to comply with DORA. It could be sooner, but I think it will definitely be at some point later on in the year where we begin to see supervisors going to the firms that they're regulating and seeing what's actually happening with DORA compliance. One of the things I have noticed in the surveys and studies being done by regulators at the moment, you know, Sweden's national regulator, for example, has said that firms are struggling to adapt to the new third-party risk management rules the most. And I think a big part of this going forward is going to be scrutinizing contracts with third-party providers of IT. The CrowdStrike outage this year, and I feel like there's been so much news this year that you almost forget that that was, you know, only about 6 months ago. And you know, I had friends, for example, who weren't able to do any work because all of their work was on things managed by CrowdStrike. That's going to be a huge problem for firms if something like that happens again. And it's going to be a huge problem for the European Commission as well, because they're going to be thinking, we've drafted this DORA, you know, what is, how come it's not being able to stop things like this from happening? So there's going to be a lot of pressure on the regulators and the payment service providers and other parts of the financial system to make sure that cybersecurity, cyber resilience becomes more of a priority than it already is. And I would say at the moment, it is definitely something that's up there. It's a lose-lose situation not to have operational resilience being pitch perfect in your firm, for sure.
That's definitely very interesting, Jimmy. I think I was wondering whether you'd agree that the first fine or the first enforcement action we see could possibly be a indicator of just how thorough regulators are going to be in enforcing cyber resilience. As you said, any audits are likely going to take some time. So, you know, could this be an indicator of just how far they're willing to go?
I think absolutely. I don't know when, you never really know when a regulator is going to start enforcing. There's some kind of, there's some kinds of regulation that seem to get a lot more attention than others. For example, most of the fines that I've seen being bestowed upon payments and money firms so far have been for money laundering, and vulnerabilities related to that, not necessarily allowing money launderers onto their systems, but not doing the necessary protocols that regulators expect from them to prevent that from happening. So I think that we could see DORA taking the same kind of precedence from regulators, and I would be, yeah, I wouldn't be surprised if maybe in Q4 we start to see action being taken. It could be targeted though. The regulators, such as some of the larger financial regulators, could opt to go for certain kinds of companies first. We've seen that happen with the consumer duty. The FCA has made it pretty clear what kind of companies it wants to go after first when it comes to who should be complying with what.
Interesting. So there's a lot of wait and see at the moment, and hopefully we see the light in a little bit.
Yeah, unfortunately, I think there's always a lot of wait and see when things first come in. But I think firms need to make sure that they're absolutely ready for what's going to be a mammoth piece of regulation that's going to change things in the EU. It's going to be, I think, as big as something like GDPR, the DORA regulation, and coming up to standard with that.
Yeah.
And unfortunately, for payments firms, it's not necessarily something that they're that used to yet. Things like these big pieces of regulation that aren't just targeted at payments firms. So I would say that there's certain, the larger banks and others are going to be able to swallow the impact on resources. I think payments firms are going to have to be a lot more smarter with how they comply with quite prescriptive requirements on IT that are coming out of the DORA.
Very good. As interesting as the discussion this is, I think it's time we moved on to some of the questions that we've been getting from our audience. What say you?
Yeah, absolutely. And I can see one of them that's come in is about from the EU payment service package, which was brought in June 28th in 2023. So it's being negotiated at the moment. And it's something that people always ask, and there's not really a way of getting an answer on it, unfortunately. But it's are the PSR, PSD3, FIDA, and digital euro likely to be finalised next year? In terms of the deadlines for that, I think that we could see FIDA be one of the first pieces that gets agreed. I think that could be signed off quite quickly because the European Parliament and the Council have established their positions on it. The only thing I would say with that, though, is that there's some work to be done to bring together the Council's position, the European Parliament's position, and the European Commission. They're in different places at the moment. Whether we see some of the more bold parts of that actually happen is, certainly remains to be seen. I'm wondering whether we're actually going to see big tech firms completely excluded from the FIDA regulation, as the European Parliament wants, or if there's going to be something a bit more nuanced happen. With the PSR and PSD3, it's not anticipated that it's going to get completed in the first 6 months of the year. I think that we're going to maybe see more traction on that in autumn of next year. I think that's when we're likely to see those pieces of regulation pass. And with the digital euro, it's been incredibly divisive on the whole. People still aren't that keen on it. The industry certainly isn't. The European Parliament certainly isn't either. And there's a lot of different voices who are pretty unpersuaded by it. So that's coming from the left and the right of different parts of the EU. So I think a lot of work needs to be done by the ECB to prepare everyone for this. I think that they've put in so much money already that it's not going to get deserted. But maybe the ECB is going to have to think hard about getting industry minds in there, which they're doing a bit of already, and thinking about how they can actually make this a viable alternative payment for people to use in Europe, and fulfill those dreams of the Commission, of different member states, and of the ECB on actually getting a European solution for payments out there, which is what I think ultimately a lot of people want at the moment.
I definitely think that CBDCs are going to be a big topic for debate. And well, they have been, and they're going to continue to be a big topic for debate as we move forward. We've had places like Thailand, for example, which has been very keen on CBDC recently, saying that they still don't see the case for a retail one. So it looks like it's not all just the digital euro that's facing its own challenges.
Yeah, I mean, with the jurisdictions that you're following, have you seen, how many of them are looking at retail use cases, and which ones of them are looking more at the wholesale side of things?
I think the vast majority of them are looking at wholesale. Yeah, I know Hong Kong, for example, has toyed with the idea of retail, and China has as well with its digital yuan. But I think for the vast majority of APEC countries, I think they're very comfortable with what they've got at the moment, and their main challenge has been wholesale settlement. So that's where they're really focusing. We're seeing stuff like Project Nexus and Project Dunbar coming up, and they've been making good progress on that. So I think I really expect to see much more of that next year, and a bit less of retail, I think.
Yeah, I mean, it seems to be the same in the UK and EU. There's definitely a push from the industry for there to be wholesale solutions out there. But then you see the Bank of England and the ECB are both very focused on the retail side, and they seem to think that's the part that they need to concentrate on the most. So yeah, it's definitely one that seems to divide people. Certainly in a place that I don't think there's going to be any CBDC stuff happening is in the US, because President Trump has made it pretty clear that he's not interested in a CBDC at all. I think he said he was going to block it at one point, and certainly the people around him as well, and that includes Republican senators, Republican House of Representatives members, are saying that they're also unenthusiastic about the idea of a digital dollar. So that might be the leading jurisdiction for backing away from it. We have seen it being deprioritized in other jurisdictions, though, such as Canada and Australia as well. So I wonder whether the tide is going to start to turn on retail CBDCs next year. And I wonder as well, do you think that there's going to be regulation targeted at financial services when it comes to AI? Is that something you're seeing in the APAC region at the moment, Prasad?
I think there already is. Taiwan consulted on specific AI rules for financial services providers earlier this year, and Singapore has already released its sort of principles for, if I remember correctly, principles for good use of AI in financial services. Currently only limited to banks, but basically illustrating what the authority sees as a good and reasonable use of AI within those systems. And we've seen lots of chatter about it, so I definitely expect a lot more to come out as we move forward.
Interesting. It's not been something that I think has been emphasized as much at EU level at the moment. I feel like the EU and UK are both pretty focused on looking at the use cases for AI, but there's not necessarily any talk about any targeted regulation coming out. And actually, it does seem like people want to try and slow down regulation of AI. It's certainly beyond the most risky use cases. It feels like things like the AI Act are largely there just to be kind of guardrails rather than be something that's going to target any particular industry. Saying that though, the European Commission did start consulting on the use cases for AI earlier this year in the EU. And also, there has been, similar to Singapore, a lot of reviews being done by regulators. So I think Denmark's regulator, Sweden's regulator, the Netherlands as well, on the pros and cons, best and worst of how people are using AI at the moment in the financial services. So I would say that people are still in that discovery stage from a regulatory point of view. In the US as well, I mean, we have got Elon Musk now in government potentially, which still feels strange to say. But I think maybe we're going to see quite light regulation coming out of the US. There was a bit of work done by some of the state level governments. So California, New York, I think put in some stuff mainly targeting workers. So pretty pro worker things that were coming out of those when it came to AI, but not so much when it's come to actually things targeted at what payment service providers are doing. And I think that we're likely to see maybe some guardrails, maybe some like necessary protections, but nothing too severe when it comes to regulation of AI yet, because we're still in such early days for it.
Well, don't you think this might be a bit concerning, given that recently we found out in the UK at least that the vast majority of banks are already using AI?
I think that it could be something that's concerning. I guess it depends on how people are using it. I mean, as long as people aren't using it to share personal data, I think that's the kind of thing where But then actually it's an interesting point. Would that be something that would come up against the consumer duty? I think banks are going to really have to think about things, or payment service providers are really going to have to think about things like how they comply with very consumer focused regulation like the consumer duty, to make sure their use of AI is creating good consumer outcomes and not leaking data to systems that they may not necessarily understand. Yes, it might make their jobs easier, but is this something that they're paying attention to when it comes to customer data? So yeah, I think we could start to see some kind of investigations happening, and we could even see consumers becoming more savvy about launching complaints against payments firms or others if they feel like AI is being used and abused. But yeah, I think at the moment, other than that, on the whole, we are still very early days, discovery stage with how to actually approach this issue, which I don't think is the end of the world either. So that's pretty much everything that we have time for today. There are some questions that I know we haven't been able to answer yet. We have taken notes of them, and we will be able to get back to you by email. But I wanted to say thank you very much, Prasad, for coming on and talking, and also everybody have the best Christmas and Happy New Year in the weeks to come. I'm sure we'll be back here next year with plenty of new regulations and things to talk about, because as we know with this industry, things never quite slow down. So I'll pass back to Jack now, but thanks very much everyone for tuning in today.
So much.
Thank you, Jimmy and Prasad, and thank you for attending today's session. As mentioned at the start of the broadcast, this webinar was recorded and a video will be sent to all attendees in the coming days. If you asked a question during the broadcast that was not answered, a member of the Vixio team will look to get back to you with a reply in the coming days. Finally, if you have any additional questions or anything else that was discussed in today's webinar or would like further information, please email info@vixio.com or visit our website vixio.com for more information. Thank you very much for attending today's webinar.